Neal Isaacs, the Raleigh business broker, coming to you with more content for business owners, business buyers, business advisors, anybody who's in the SMB world and wants to learn about transactions. I'm a small business transaction specialist, and I love to record videos here in this platform to educate people like you want to learn about deals. Today, I'm going to get right into asset allocation. So let's take a look at an actual purchase price asset allocation. This is an actual deal. The names have been changed to protect the innocent, and it was done sometime last year. The total purchase price was $475,000, but this is how it was allocated. Some of it went to IP, some of it went to FF&E. That would be like the tables and chairs, the hard stuff. That's what people think about with FF&E. I'll skip over the goodwill. There was a restrictive covenant, and some value was placed on that to say, hey, business owner, seller is not going to practice this for some amount of time, some amount of space, this particular flavor. The buyer paid this much in order for them to not do that. And in order to get to the 475, the remainder was goodwill. So that's how this 475 was allocated across these different buckets, let's call them. They each represent something different. This is what a purchase price asset allocation is. It's not saying this is an asset sale, is a stock sale. It's allocating the purchase price against different categories. We're going to look at them in a different way, the way the government looks at them, but for the layman's terms, for what the buyer and the seller agree upon, what's transferring, this is how it's expressed. This is from an asset purchase agreement. It's not delineating between an asset sale and a stock sale. I know it has the word asset in it, but I learned recently that even a stock sale, wise to include a purchase price allocation. What the purchase price allocation really is it's agreeing for the buyer and seller on what was bought and sold. They've already agreed on the purchase price, and hopefully they've agreed on terms when this seller will receive his or her money from the buyer and in what type of consideration that is. But this is saying to the IRS specifically, how are we going to record it? What are we going to tell the government what was bought and sold? So why does this matter? For tax purposes. And this becomes a deal point because in general, business buyers like to buy tangible assets. And business sellers like to sell assets that match what their books currently show that they have on the books or better, right? The challenge for the business seller is if they sell more assets than their books show that they have, they could pay extra taxes. And conversely, the opposing force for the business buyer is they want to be able to depreciate the assets. And the deal that I just showed, let's say it was $500,000, they would have liked it to be 100% for $500,000 to be all tangible assets. There's a world where that business owner could make $500,000 in his first year in business and pay zero taxes because they could make $500,000 and they could write off $500,000 in depreciating all of those assets that they just bought. In reality, it doesn't really work that way, but that's the beauty of the tax code and of having hard physical, tangible things that can be written off. Now, that business buyer can write off the goodwill. It's called amortization, but it takes much, much longer. I think it's 10 years or it's longer than that. It's a very long period of time where they slowly write off a little bit each year. What the buyers want is those tangible assets. They want to write them off quickly so they don't have to pay taxes. But again, if that business buyer does that and the business seller says they sold $500,000 of assets when in previous tax returns they've told the government that they have done that depreciation already, the government, and I'm speaking surreptitiously here, Uncle Sam says, well, wait a minute, Mr. Business Seller, you already wrote off that $500,000. So you already saved that money. So we're going to do something called depreciation recapture, which means, well, all that money that we let you save in taxes, why don't you pay us back now? And this is not good for business owners' taxes after they sell. So that's a little bit about what a purchase price asset allocation looks like on the deal-making stage. Now let's look at what it would look like when the business owner and the business buyer files it on their taxes. Here we have a Form 8594. So we're getting in some IRS jargon here, but this is what I call purchase price asset allocation. This is where that data goes. So we called it tangible assets, FF&E, goodwill. The government's going to call this class 1, class 2. Talk with your CPA about how that translates. But look at this, allocation of sales price. This is where all those dollars go. This is how that 475K is called $500,000. That's how it's spread out across these different classes. This is being recorded in 2024. Close the deal this year, sometime in March, April of 2025, buyer and owner are going to file this same form. One says they bought, one says they sold. And we really want those to match, right? We're looking to not get flagged for an audit. So could they not match? Yes. Does that raise the possibility of an audit? Possibly. So let's avoid that, right? Let's agree and have this form filled out and have it agreed upon in advance. So how do we wrap all this up? You're a buyer, you're a seller, you have a deal, you've structured the deal with how people are getting paid. Make sure you understand what the purchase price asset allocation will be and the repercussions for your taxes. If you're a buyer, will you get to depreciate and save taxes in your first year and in the early years? Or if you're a seller, are you going to have to pay depreciation recapture? At my office, when we do deals, our process is when we start a relationship with a new client seller, we go to their CPA and we say, what is the appropriate asset allocation for selling a business based on its current books, based on this selling price? And we have the CPA recommend that. And then when we get and talk, we'll advertise that the business that's what a fair asset allocation is. When we advertise it, we will typically say, this is what we sell the business at this allocation. And the buyer, as part of their terms, they can tell the price. They should also say, this is kind of where I expect my asset allocation to come in. If there's a substantial difference, we'd like to know that up front. That's how we negotiate asset allocations. Some brokers, some attorneys will close a deal with language that says asset allocation purchase price to be determined before the taxes are filed. I think this is not a good way to proceed. You're kind of pushing that problem down the road. I'd rather have buyer and owner in agreement before the closing. But that's how we do it at our office, and I invite you to share what works for you. I'm Neal. Tell me if you have a question, put the comment down below, or send me a direct message. We respect confidentiality. There's many ways to find me online, but Neal Isaacs on LinkedIn is probably the easiest way. Thanks for watching. Till next time, mahalo.